Imagine you just bought a coffee, $7. You paid with your credit card, and as you walked out, your phone buzzed. A notification. You earned 3% cash back on your purchase, 21 cents returned to your account. You smiled. Of course you did. You got something for nothing. You spent money you were going to spend anyway, and the bank handed you a little gift on the way out the door. It felt good. It was supposed to feel good. Now imagine you could see, just for a second, what was happening on the other side of that transaction. Not your side, their side, the bank's side, the network side, the merchant's side. The quiet, invisible machinery that makes that 21 cents possible. You would not smile. Not because you did anything wrong, but because the moment you understand how cashback actually works, how it is funded, who pays for it, and what it is designed to make you do, the whole thing starts to look less like a gift and more like a very elegant trap. One that you walked into voluntarily, one that most people will never leave. This is the story of cashback, how it was invented, how it scaled into a trillion-dollar behavioral engine, and why the people who designed it understood human psychology far better than most of us are comfortable admitting. Let's start somewhere most people don't, not with rewards, not with points. Let's start with a gas station in the 1980s and a problem that nobody thought was a problem yet. When credit cards first became common in American life, and we're talking the late 1960s, early 1970s, they were a convenience product. You didn't have to carry cash, you didn't have to write a check. You swiped, you signed, the bill came at the end of the month. Simple, clean, elegant for its time. But the banks had a challenge. The cards were useful, sure, but useful isn't the same as compelling. People used their cards when they needed to. The rest of the time, the cards sat in the wallet, dormant, silent, not making anyone any money. Because here's how credit cards actually make money, and this is the first piece of the system you need to understand before any of the rest of it makes sense. Every time you swipe your card, the merchant, the store, the restaurant, the gas station pays a fee. It's called an interchange fee, sometimes called a swipe fee. It runs, on average, somewhere between 1.5% and 3% of the total transaction value. So if you buy $100 of groceries, the grocery store doesn't get $100. The grocery store gets somewhere between $97 and $98.50, and the rest flows to the card network, Visa, MasterCard, American Express, and to your bank. That fee is the heartbeat of the entire credit card economy. It's not interest, it's not late fees, it's that quiet little tax on every transaction, paid by the merchant, invisible to the consumer. In the early days, the fee existed simply to cover the cost of processing payments and managing credit risk. The banks weren't getting rich off interchange, it was maintenance revenue, operational. But then someone at Discover, and it was specifically Discover in 1986, had an idea. What if we gave some of that interchange back to the cardholder? Not all of it, just enough to make the card feel like it was paying you, just enough to make you reach for it first instead of cash, just enough to create a habit. Discover launched its Cashback program with a simple promise, 1% back on every purchase. And in 1986, that was genuinely revolutionary. People had never been paid to spend before, or at least they'd never been made to feel that way. Card usage went up, transaction volume went up, interchange revenue went up, and crucially, and this is the part that made the strategy genius, the cash back they were paying out was almost entirely funded by the interchange fee that was already flowing in. They weren't giving money away, they were returning a fraction of a fee that consumers never knew existed and calling it a reward. The game had just changed. Now, Discover didn't stay alone for long. When a strategy works this well, the industry notices. By the mid-1990s, American Express had launched its own rewards ecosystem. Citibank was experimenting. Chase was watching carefully. And by the 2000s, cashback and points programs had become not just common, but expected. If your card didn't offer some form of reward, it was a relic. But something else was happening beneath the surface of all these reward programs, something that took longer to become visible. The interchange fees were going up. Not dramatically, not at once, slowly, consistently, across decades.
Premium reward cards, the ones offering 2%, 3%, 5% back on certain categories, needed higher interchange fees to fund those richer rewards. So the networks and banks lobbied for, negotiated for, and simply implemented higher swipe fees on premium cards. By 2023, the average interchange fee in the United States sat at around 2.24%. In some categories, on some premium cards, it runs closer to 3 or even 3.5%. To put that in perspective, in Europe, interchange fees are capped by regulation at 0.3% for credit cards. In Australia, the cap is around 0.5%. The United States has no such cap. The result is that American merchants pay some of the highest processing fees in the developed world, and those fees don't disappear. They get built into the prices of everything you buy. Your coffee isn't $7 because it costs $7 to make. It's $7 partly because the shop owner has to factor in the cost of accepting payment. When a meaningful percentage of customers pay with premium rewards cards, the merchant isn't just covering their cost of goods, they're covering your reward program. Which means the 21 cents you got back on that $7 coffee, someone already paid for it. The barista's employer, to be precise. It got baked into the price so quietly, so structurally, that it feels like it came from nowhere. It came from everywhere. Here's where the story gets uncomfortable, and this is the part that very few cashback enthusiasts want to sit with. The interchange fee system doesn't treat all customers equally. If you walk into a store and pay with cash, you pay the sticker price. The merchant collects the full amount. There's no swipe fee, no interchange, no processing cost. Transaction complete. If you walk in and pay with a basic debit card, the interchange fee is lower, often capped around 21 cents per transaction in the U.S. for large bank debit cards, thanks to the Durbin Amendment passed in 2010. But if you walk in and pay with a premium rewards credit card, the kind offering 2 or 3% cash back, airport lounges, concierge services, and a metal card that makes a satisfying sound when you set it down, the merchant pays something closer to 2.5 or 3% on the transaction. And that cost gets rolled into prices. Now, here's the part that keeps economists up at night. And this is the part that very few cashback enthusiasts want to sit with. The interchange fee system doesn't treat all customers equally. If you walk into a store and pay with cash, you pay the sticker price. The merchant collects the full amount. There's no swipe fee, no interchange, no processing cost. Transaction complete. If you walk in and pay with a basic debit card, the interchange fee is lower, often capped around 21 cents per transaction in the U.S. for large bank debit cards, thanks to the Durbin Amendment passed in 2010. But if you walk in and pay with a premium rewards credit card, the kind offering 2 or 3% cash back, airport lounges, concierge services, and a metal card that makes a satisfying sound when you set it down, the merchant pays something closer to 2.5 or 3% on the transaction. And that cost gets rolled into prices. Now, here's the part that keeps economists up at night. And this is the part that very few cashback enthusiasts want to sit with. The interchange fee system doesn't treat all customers equally. If you walk into a store and pay with cash, you pay the sticker price. The merchant collects the full amount. There's no swipe fee, no interchange, no processing cost. Transaction complete. If you walk in and pay with a basic debit card, the interchange fee is lower, often capped around 21 cents per transaction in the U.S. for large bank debit cards, thanks to the Durbin Amendment passed in 2010. But if you walk in and pay with a premium rewards credit card, the kind offering 2 or 3% cash back, airport lounges, concierge services, and a metal card that makes a satisfying sound when you set it down, the merchant pays something closer to 2.5 or 3% on the transaction. And that cost gets rolled into prices.
The card companies know this. They've known it for decades. The move to real-time push notifications for cash back wasn't just a technical upgrade. It was a deliberate psychological calibration. The ping, the number, the small green number, delivered immediately, tied directly to the transaction. You bought something, you were rewarded. Do it again. It is, structurally, a slot machine. You pull the lever, swipe the card, and occasionally you get a satisfying reward notification.
Not every time is equally exciting. Gas station purchases, grocery runs. But sometimes, here's the 5% category activation. Here's the sign-up bonus landing. Here's the quarterly reward redemption. The number is bigger, and the feeling is disproportionately good. B.F. Skinner, the behavioral psychologist who spent his career studying how reward schedules shape behavior, identified long ago that variable reward schedules are the most powerful conditioning mechanisms humans experience. Not consistent rewards, not rare rewards, variable ones. Sometimes big, sometimes small, always somewhat unpredictable. He was talking about pigeons in a laboratory. But credit card companies, whether they read Skinner directly or simply learned the same lessons from decades of watching consumer data, built systems that behave almost exactly as Skinner's research would predict. Now let's talk about the people who are in fact winning this game, because they exist, they are real, and understanding them is important. There is an entire subculture online, Reddit communities, YouTube channels, entire websites dedicated to what's called credit card optimization, or more dramatically, the travel hacking ecosystem. These are people who have turned the cashback and points system into something that resembles a part-time job, and in some cases, an actual full-time one. They sign up for 10, 15, 20 credit cards over the course of a few years. They time their applications to hit minimum spending requirements during months when they have large planned expenses, the annual insurance premium, the home renovation, the holiday spending. They route their business expenses through their personal cards. They move between bonus categories with precision. They redeem points not for cash, but for business or first-class airline tickets, where the cents per point value is 2, 3, sometimes 5 times higher than a direct cashback redemption. The math, when done carefully, is real. Some of these people genuinely extract thousands of dollars a year in value. Stories of round-the-world business-class trips funded entirely by credit card points are not fictional. They happened. They continue to happen. But here's the thing about those people. They are the extreme outliers. They are the ones for whom the game was not designed. The game was designed for everyone else. Think about it from the issuer's perspective. If every single cardholder maxed out their rewards, hit every bonus category, paid their balance in full every single month, never paid $1 of interest, and redeemed everything at maximum value, the cashback program would be a money-losing proposition for the bank. It cannot survive on the interchange fee alone if every user extracts full value. The program survives because most people don't do that. Most people spend somewhat more than they would have otherwise. Most people carry a balance some months. Most people redeem at suboptimal rates, or forget to redeem at all, or let points expire. In 2019, before the pandemic distorted travel patterns, American consumers held an estimated 23 trillion points in unredeemed loyalty currency across all programs. Travel points, hotel points, airline miles, cashback, 23 trillion. Much of it expired. Much of it was redeemed for the equivalent of a cup of coffee when it could have bought a flight. Some of it just sat, accumulating quietly in accounts that people checked once and forgot about. That unredeemed value, that gap between what was promised and what was collected, is called breakage in the industry, and it is a significant and deliberate part of the business model. You are not the customer. You are the target. The difference is important. Let's get into the numbers, because the numbers are where the whole story sharpens. The average American household carries credit card debt. The exact figure fluctuates, but it hovers reliably somewhere above $5,000 in outstanding revolving credit. That's the average across all households, including the ones who carry zero debt, which means the median indebted household is carrying significantly more. The average interest rate on credit card debt in the United States, as of early 2024, sat at approximately 22% annually. 22%. That is not a typo. That is not a subprime special rate. That is the national average. If you're carrying $5,000 of credit card debt at 22% annual interest, you're paying approximately $92 a month in interest charges. Over a year, that's $1,100. Your 2% cash back card, used heavily, might return $400 to $600 in cash back annually if you're running significant spend through it. The math is not subtle. If you carry a balance, you are giving back your cash back and then then some in interest, often much more. The rewards program is mathematically irrelevant if you're not paying your balance in full. The card companies know this. They know it precisely. They know it because they designed it precisely. The rewards card is not two separate products stitched together. It is one product with two mechanisms working in concert. The cashback mechanism attracts customers, encourages higher spending, and creates loyalty. The interest mechanism captures the revenue from the customers who get seduced by the first mechanism and use more credit than they can cleanly repay. They work together. The reward is the lure. The trap is the interest. And here's the statistic that makes this crystal clear. According to the Consumer Financial Protection Bureau, approximately 55% of credit card users pay their balance in full every month. They're called transactors. They use the card, get their rewards, pay it off, and never pay a cent of interest. The other 45%, called revolvers, carry a balance. They pay interest, and they generate an enormous share of total credit card industry revenue. The transactors are, from the bank's perspective, acceptable losses. They use the infrastructure, they generate interchange fees, they serve as proof of product quality, and some of them will eventually become revolvers. Life happens. Job loss, medical emergency, unexpected expense. The credit line is right there. The revolvers are the core business. The cashback program is, among other things, a remarkably effective pipeline from one category to the other. There's another number worth sitting with. The credit card industry in the United States generated approximately $260 billion in revenue in 2022. That's the total. Interchange fees, interest charges, annual fees, late fees, foreign transaction fees, all of it combined. $260 billion in a single year from a single product category. To put that in perspective, that's more than the GDP of Portugal, more than the combined annual revenue of Apple and Amazon in some years. It is one of the most profitable business models in the history of financial services.